Hello, my name is Jacob Lefker, and I am a financial coach with the Community College Credit Building Initiative. This initiative provides free financial coaching to students at your institution. Today, we're going to be discussing very important topics that have to do with not only spending and creating a spending plan, but also how to manage credit cards, how to understand the way in which credit scores are calculated, and we'll also dive into some emergency resources as well. As I mentioned, the Community College Credit Building Initiative is a new initiative at Bunker Hill Community College. This is a program that provides free financial coaching as well as free financial literacy workshops and webinars like this one to students at Bunker Hill. What are we going to cover today? Today we'll be covering resources for COVID-19 preparedness. We will also be covering how to make a spending plan, how to categorize your needs versus your wants, how to choose your own credit card, how to use credit cards to help improve your credit score, and last but not least, how to read your credit report. COVID-19 resources. As we know, this is an incredibly difficult and unprecedented time when it comes to life and how it has changed for everyone around the entire world as a result of COVID-19. Here in Massachusetts, the Consumer Financial Protection Bureau has lots of information that covers a whole range of topics, everything from information for renters to information for folks who are furloughed and or laid off entirely from their jobs as a result of COVID-19. I highly recommend the link that is here from the Consumer Financial Protection Bureau to help you in as many different ways as possible based on the way in which COVID-19 has affected your life and your family's life. In addition, a second organization called Economic Mobility Pathways has also compiled lots of information on financial resources as well as food resources and shelter resources available for folks around Massachusetts based on your location. So go to their link here to access those resources as well. Shifting now into what exactly is spending and how to create a budget, I want to first shift our sense and the connotation that we associate with the word budget away from a negative connotation into a different framework. This framework is one that I feel is super important to help folks like you and help folks like all of us feel that we are more in control of where our money is going each month. So first and foremost, it's important to recognize that spending is not bad. Spending is something that we really have to do in order to live, in order to function, in order to communicate with each other, in order to move about, in order to have fun. So my recommendation for you is to think about spending not as necessarily a bad thing, but as something that first and foremost is required in our lives and is something that we can have control over. So by reframing our approach to budgeting and spending, we can be better in control of where our money is going. And if we are better in control of where our money is going, that means we are able to save more, have more available for emergencies, have more available and build up more in savings in order to make the types of purchases that are going to make us happy and that are going to help us grow our wealth in the long run. So, how do we create a spending plan? A spending plan is another name for a budget, but as I mentioned before, let's reframe our thoughts and our approach to the word budget, and let's call a spending plan, let's call a budget a spending plan instead. The first step for creating a spending plan is to determine your net income per month. So net income refers to how much money you have left over after all of your expenses are paid. Your gross income refers to how much money you have coming in before taxes and before any of your other expenses are paid with that money. The second step is to determine your monthly fixed expenses. So fixed expenses refer to charges and expenses that you must make every month that are relatively consistent, if not exactly the same, every single month. So a car loan, for instance, would be an example of a fixed expense. Let's say your car loan is $200 a month. That is not going to change necessarily every single month, so we would consider that a fixed expense. Your rent is often thought of as another fixed expense. So is a mortgage or a payment for financing a phone through your phone company, for instance. Now, the third step is to determine your monthly variable expenses. So variable expenses, as you can probably guess, do often change from month to month. So one example of a variable expense would be your credit card statement balance. Most people are not spending the exact same amount on their credit card every single month. Therefore, the amount that they owe the following month is going to be different. So a credit card statement is one example of a variable expense. Now, step 4 is a very personal step. Step 4 really requires you as an individual, you as a parent, you as a member of your family and a member of your larger community to think about what is priority for you. So for most people, priority number 1 comes to their home, their living situation. So whether they're renting, whether they're paying a mortgage, that is one of the most important categories when it comes to expenses for most folks. Now, someone who really loves to travel compared to someone who doesn't travel very often, then that difference in preferences is going to have an impact in how each of those two individuals prioritize, and it's very likely that their priority rankings are going to be different compared to one another. So in step 4, I encourage you to jot down, make a list, rank it 1 through however many numbers you need to create that prioritization that is really, really helpful, both as a self-reflection tool, but also as something that you can refer back to when looking at budgets for future months, when looking at your comprehensive budget for the entire year. Because by doing that, you can create a spending plan that you are more likely to stick to and more likely to give yourself the financial freedom to make the types of investments, to build up the savings that you would like, and also to be able to afford to do the fun things that you enjoy. Step number 5. I highly recommend using an app or even an expense journal. An expense journal could be handwritten. It could be a Microsoft Excel spreadsheet, for instance. But there are also apps, and I'll mention a few of those in just a minute. There are apps that can also track your spending and can track your income, and therefore essentially help you create a spending plan that is digital that you keep on your phone. Last but not least, the last step is to decrease spending. So spending plans can really help us visually see whether we have a surplus, that means money left over after all of our expenses are paid each month, or whether we have a deficit, so not enough money in order to cover all of our expenses in a given month. So whether an individual has a deficit at the end of the month or has a surplus at the end of the month, there are often many areas in which someone can decrease their spending without sacrificing the level of service or the level of experience and joy that they receive from a particular expense. So that's another very important reason for having a spending plan, because it amalgamates everything into one visual tool that we can then modify month to month and track over the course of a year how progress is going towards our secondary goals of saving for emergencies, saving for large purchases, and also saving to invest. Now here's the tricky part. How do you determine what exactly is a need versus a want? This is a very personal decision. Someone who has a lot of shoes, right, might consider that to be more of a need than someone who only is fine with 1 or 2 pairs of shoes and that lasts them for a year or 2. So When it comes to determining your needs and wants, it's important to have done the prioritization from your spending plan already. So follow the steps in the previous slide to create your spending plan, and then take a step back and do the analysis that I'm about to show you to determine what exactly is your group of needs and what exactly is your group of wants. So after having made the list of all of your expenses in a month, I encourage you to group these into the two categories based on your priority list from the spending plan creation. So what do you feel is a want for you, and what do you feel is a need for you? Then we're going to use this spending plan budgeting rule that is called the 50-30-20 method. The 50-30-20 method is super helpful to help organize your income each month. So what does that mean? That means that 50% of your income within this method, right, according to this method, 50% of your income should go to cover your needs, okay? Then 30% of your income should go to cover your wants. And then the remaining 20% should go towards savings, towards investments, to be put away in some form so that you can continue to grow your money and allow your money to build you more money. So once you have your two categories, once you have your expenses listed and categorized into your two categories of wants versus needs, then you're going to use the 50-30-20 budgeting rule to analyze those two groups. What does that mean? That means you're going to calculate the amount of money that you have coming in per month. You're going to set aside 50% of that to go towards your needs. You're going to set aside 30% of that to go towards your wants. And you're going to set aside and reserve 20% of that to go into savings or to go into your investment portfolio. So based on that subgrouping of your income, then you ask yourself, do you have enough in your 50% to cover your needs based on the groupings that you made earlier? Do you have enough in the 30% to cover your wants based on your expenses grouping earlier? If not, then it's important to trim from the wants categories by perhaps removing some of those expenses if you feel that you can do that, or by finding alternatives, whether that's a different company, whether it's a different service plan, for instance, to hopefully not sacrifice a lot of that service or that type of product that you're buying, but to do so at a lower cost, which in turn would give you more money left over that could go be allocated to that 50%, so that you can indeed cover your needs, which is most important. So I highly recommend doing this process for yourself. It is very, very straightforward, but it's super important as well. And there's a link that you can see here at the bottom of this slide at nerdwallet.com that will help you do those actual calculations and help you think about visually how to apply the 50-30-20 budget rule to determining your needs versus wants. Now, we're going to shift slightly into credit cards. But why talk about credit cards after talking about needs versus wants? Here's why. For folks who have never had a credit card before, it can be difficult to choose one. It can be difficult to fully understand why having a credit card is helpful in the long run. And it can be difficult to fully grasp how credit cards relate to your credit score and to your credit report overall. So that's what we're going to tackle in this section of the presentation. Overall, credit cards are much more secure than cash and debit cards. If you drop $20 on the ground and you don't realize it until the next day, it's probably not going to be there the next day. If someone were to steal your debit card and your PIN, that money that they steal from you, whatever they charge to your debit card, is going to come automatically out of your bank account, and it's very difficult to return that money into your bank account because it's debited out right away. With a credit card, if someone were to steal your information, whether they stole the entire card or they stole the credit card number, and they charge something to your credit card account, you can right away, upon noticing that, you can dispute that charge with your credit card company, and they will do an investigative process. And if they determine that that indeed is a fraudulent charge, then they'll refund your account and or remove that charge right away if it hasn't posted yet. So that's why credit cards are much more secure than cash and debit cards. It's also important to think about credit cards as a purchase now and pay later tool, but one that doesn't mean purchase now and pay a year later or 2 years later. It really should be thought of as a purchase now and give yourself a 1-month loan in order to pay it back a month later. Last but not least, credit cards are a form of revolving credit, and it's important for your credit score to boost your credit score as much as you can to have different types of lines of credit. What does that mean? Well, there are two main types: revolving credit and installment credit. Revolving credit is very similar. Revolving credit refers specifically to amounts that you owe each month that are different. So credit cards are a great example, again, of revolving credit, because the amount that someone charges on their credit card is usually different every month. A mortgage, for instance, to pay back pay back the purchase of a house, that is a fixed expense for most people, and therefore that would be an example of an installment loan. Other examples of installment loans include auto loans, include loans where you finance your phone through Samsung or through Apple specifically, for instance. So these are examples of installment loans, whereas credit cards are examples of revolving loans. But it's helpful to have types of both loans under your belt and under your management. Now let's discuss credit scores briefly. What is a credit score and what exactly does it mean? First of all, credit scores can range from 300 to 850. Credit scores are super, super, super helpful when it comes to accessing the loans that can help us make the purchases that can build us equity and build us wealth in the long run, and that we can then pass down to our kids and future generations as well. So let's think of credit scores as the measure that banks and other lending institutions use to determine how trustworthy you are as a potential customer to pay back the loan that they're potentially going to offer you on time. So we think of the number 660 as a prime credit score because once you have achieved a 660 and go beyond 660, you often have more access to safer, more affordable loans and other products. Now, it's important to recognize that there's not just one type of credit score and that companies use different types of credit scores. You might have heard of the FICO credit score. We'll get into how that one is calculated exactly a little bit later in this presentation. But there's also a Vantage credit score, which is a slightly different calculation. So what does that mean? It's important to recognize that if you check your credit score on your credit card company's website, but you also check it on another external website, you may end up coming up with different score numbers. They're hopefully not drastically different, but they could be slightly different. And that's because there's more than one type of credit score calculation. And one bank might use the FICO credit score calculation for most of their clients. Another might use a different one. So it's important to recognize that for each individual, there's usually more than one credit score at any given point in time. So understanding why credit cards are important, and now also understanding what exactly the credit score is, how can we use credit cards to help improve our credit score? That's something that's super important to understand before even choosing a credit card. So the first step in choosing a credit card is to consider the next 4 factors. The first one is APR. APR is an acronym that stands for annual percentage rate. The second most important factor is to consider the credit limit. Thirdly, you want to consider if there's an affiliated company or rewards program for that particular credit card. And last but not least, is there an annual fee? Now, the annual percentage rate refers to the interest that's charged on any balance that remains on the credit card beyond the statement balance due date. So let's think of an example of a credit card that has a 24% APR. That means over the course of a year, 24% will be charged in interest on whatever balance is on that card over that time period. Now, it's often more helpful to think of the interest rate that's calculated on a monthly basis because, as we mentioned before, credit cards should be thought of as providing you with a 1-month loan to yourself that you're going to pay back the following month. That is what your statement balance is on a credit card. That's the amount that was due. The amount that's due for a particular due date is from the time period of a month prior. So that's what you purchased on that credit card the month prior. You've now had a month extra, right, to make sure you have that amount of money to cover the statement balance. And then you want to pay that statement balance prior to or on its due date. So a credit card that has a 24% APR would have a 2% monthly interest rate on that balance on that credit card because 24% divided by 12 months is 2%. Now, what exactly is the credit limit? The credit limit refers to the amount of money determined by the credit card company that they feel comfortable with you charging to that credit card in a month's time. So how does the credit card company determine that value? They look at you as an applicant. They look at your income. They want to know how much you're making in a given year. They also want to know whether that's full-time or part-time work. And then they're also going to examine your credit score. So with those three most important pieces of information, they can get a sense of how likely you would be able to pay back a certain amount of money in a month's time. And they use that to determine the amount, the value that they assign to your credit limit once they've approved you for a credit card. In addition, there are companies that are often affiliated with credit cards that you can use and gain points or accrue rewards miles, for instance. And so this is another important element of choosing a credit card. For instance, someone who really loves to shop at Best Buy and shops at Best Buy on a regular basis, it might make sense for them to seek and investigate a credit card that is linked to Best Buy because they're already spending money there on a relatively frequent basis. So they could accrue points and use that in their future purchases there at Best Buy. For someone who never shops at Best Buy, it probably doesn't make much sense for that person to apply for a credit card at Best Buy. There are also credit cards associated with airlines. So if someone loves to travel on a particular airline, it might make sense for them to apply for a credit card that's associated with that particular airline so that they can accrue miles that they can use to purchase flights for free in the future. Last but not least, it's important to recognize if a credit card you're applying for has an annual fee. The annual fee is a fee that you pay once per year to simply have that credit card. Now, for many folks, there might be a very good reason that they really love a particular credit card. They might love getting 4 or 5 miles per dollar spent on a particular credit card that goes to the particular a particular airline. And they might feel that it's a worthwhile fee for them to pay the $100 perhaps. That might be the annual fee on that particular credit card each year. For other folks, it might not make sense to pay $35 to $100 each year to simply have the credit card itself. So that's an important piece. It's an important factor in your decision-making process when it comes to selecting credit cards that you would like to apply for. As we mentioned, the annual percentage rate is the cost of the balances on your credit card calculated over a 12-month period. And as we also mentioned, the credit limit is the amount of the amount on a credit card that a credit card company allows you to charge to that particular card. Also, as we mentioned, there are affiliated company offers. So there might be an introductory APR offer, which we'll discuss in just a minute. There might also be bonuses that relate to points or cash back. but there also might be rewards programs, as I mentioned, that are tied to a specific airline with miles for that airline, or to a particular store with points or cash back at that store. Now, there's another type of credit card that's super important, especially for folks who have a low credit score at this point in time, or who have never had a credit card before. This is called a secured credit card. A secured credit card is slightly different in terms of how it's set up than a traditional credit card, but it works much like a traditional credit card. So here's an example, and it's important to recognize that in my role as financial coach with the Community College Credit Building Initiative, I am not affiliated with any particular bank, any particular credit card company, or any other lending institution. What I do in my presentations is make sure that you, as the audience member, has as much information as possible and has access to some examples of credit cards and other products that might make sense for you. So, how does a secured credit card work? A secured credit card works in a different way, as I mentioned, than a traditional credit card. In order to secure a secured credit card, you as the customer put down a refundable deposit to the credit card company. In this particular case, someone who applied for this card and was approved would deposit $200 to Visa. That is a refundable deposit, but they would deposit $200 to Visa, and then Visa would issue them a secured credit card like this one with a $200 credit limit. So that's a relatively low credit limit, but it's really helpful for someone who has never had a credit card before, because it provides that person with the opportunity to manage a credit card that they can then use as a credit card. But because the credit limit is $200, it's not possible for that person. It's much less likely that that person will spend lots of money on that credit card. And if they're spending lower amounts on that credit card, they're more likely to be able to pay back their statement balance each month and to do so on time. So why is this helpful? Let's think back to the credit score itself. And one of the most important factors in determining someone's credit score in its calculation is someone's payment history. So what does that mean? It means if someone is paying on time with their credit card, it can help to improve their credit score relatively quickly, and that's super helpful. If, unfortunately, someone is not paying their credit score on time, because this is the most important factor in the calculation of their credit score, then their credit score could drop relatively quickly. So, a secured credit card, by paying it back on time and by keeping the amount relatively low that someone charges on it, the individual using a secured credit card can help to improve their credit score by quite a bit in only 6 months. And that's really, really helpful to not only building someone's credit score up quickly, if it's dropped low for other reasons, or if they've never had a credit card before, but it's also helpful for someone to gain that experience managing a credit card with a low credit limit before they try to manage a credit card with a higher credit limit. So this is super helpful. And let's pretend that this individual was able to pay their statement balance for the next 6 months on the secured credit card on time. Then that would be 6 months of on-time payment history reported to the credit bureaus, and that would help improve their credit score. And as a result, Visa might even offer them a higher credit limit on this particular card without having to deposit any more money than they already deposited at the beginning. Or Visa might even offer them to apply for a traditional credit card with them as well. So this is why secured credit cards are super helpful for someone who has never had a credit card before, for someone who doesn't have a credit score yet, or for someone who has a low credit score. On this page, we see 2 websites that are super helpful to analyzing and comparing credit cards. So both bankratecom as well as wallethubcom allow you as the visitor to search on any number of different filters, whether you're looking just for secured credit cards, whether you're looking for credit cards just for travel, whether you're looking for credit cards that are more likely to be approved for someone with a low credit score, for instance. On both of these websites, you can search lots of different types of credit cards. You can save them, and you can also compare them side by side. And this is really helpful to not only do your research in a centralized website location, but also to start applying from a centralized location as well, without needing to individually search each of those credit card companies. Now, let's discuss another credit card here. This one is also from Visa. And I want to highlight this one in particular because it helps us understand what a purchase intro APR is, as well as a transfer intro APR. So, purchase introductory annual percentage rate, in this particular case, refers to this offer: 0% interest for 15 months. What does that mean? It means that when someone is approved for this credit card, for the first 15 months that they have the credit card, they will not be charged any interest on any balance that sits on that credit card during those first 15 months. Once the 16th month begins, if there's a balance on the credit card, then it could incur the regular APR rate, which in this particular case varies, as we can see, between 16.74% and 25.49% per year. So why is this helpful and why is it important to understand this? I'll give you an example from my own life. 2 summers ago, I really wanted to have LASIK surgery done to my eyes, and I got it. But unfortunately, LASIK surgery is considered to be a cosmetic surgery. That means that most medical insurance providers will not cover it. So this surgery was going to cost me $5,000, and I was not going to be able to pay up front $5,000 from my pocket. So what did I do? I applied for a credit card similar to this one. I was approved, and what I did is I charged the $5,000 for the LASIK surgery to this credit card, and therefore gave myself 15 months to pay back that $5,000 because of the purchase introductory APR offer on that card. So it didn't matter if I paid $1 one month or $2,000 another month. As long as I paid back the full $5,000 by the end of that 15th month, then I wasn't going to be charged any interest on that $5,000. So this is an example of a way in which we can leverage credit cards to give us access to the purchases that we want to make for our health, for our well-being, and for travel, for instance, for transferring a credit card debt from another credit card, but not have to pay additional money by simply having that balance sit on that old credit card. That's what the transfer introductory APR offer refers to. So this is super important to understand because it's a tool that we can use to give us access to the purchases we would like to make, but also to the freedom to make those purchases without those purchases costing us more money beyond the value of the purchase. Now, here we have a credit card simulation game. I encourage you to pause this video, take some time, go through on this link, and play this game. This game is a simulation where you are able to select different types of credit cards within the game and do some shopping and get a sense of how paying the minimum versus paying the statement balance, how that actually will cost you as the consumer more or less money, depending on the amount of money that you pay back on that credit card's purchase each month. So I highly encourage taking some time to play this game, to go through each of the 3 credit cards on there in the simulation, to get a sense of how introductory APR offers can really make a difference in making sure that you as the customer don't have to pay extra money beyond the cost of the products that you bought with your card. Now let's discuss a little bit about how the FICO score calculation is conducted itself. As we mentioned before, payment history is critical. Payment history constitutes 35% of someone's FICO score calculation. As I mentioned before, that means that someone who is paying on time each month with their credit cards, with other loans that they might have, whether it's a student loan or an auto loan or any other type of loan, that is going to help increase their credit score. If unfortunately someone is not paying on time, if they're not paying their credit score on, their credit card on time, or they're not paying their student loan on time or their auto loan on time, then that really has a negative impact on their credit score, and their credit score is going to go down relatively fast. So that's why it's super important to be on top of and cognizant of how much you're spending on your credit cards in order to ensure that you can have enough money to pay the statement balance on time the following month. And why it's also important to calculate what a particular loan will cost you each month before making a purchase that requires that type of loan. So before buying a car, make sure you get a sense of what the purchase amount of the car is broken down into those monthly payments based on the loan itself, as well as what those interest fees will be on that loan, so that you can ensure that you can afford to pay back that amount each month and to do so on time. Now, the second most important category within the credit score calculation according to FICO score model is amounts owed. So amounts owed refers to the balance on all of your credit cards, all of your other loans, right? But there's also an important calculation that has to be done within this category, and that's called the credit utilization ratio. It applies just to credit cards, so not to other types of loans, just to credit cards. We'll discuss this one in just a minute. It's also important, as I mentioned earlier on in the presentation, to have a mix of different types of credit. So having revolving credit like credit cards is important, but it's also important and helpful to have different types of other loans as well that are usually installment loans. So having that mix helps to improve your credit score as well. What exactly is the credit utilization ratio? The credit utilization ratio is the ratio of your total credit card debt to your total credit card limit across all of the cards you own. So if someone has just one credit card, then it's the balance at any given time divided by the credit limit of that card. If someone has 20 credit cards, then they would need to add up the balances on all 20 cards and divide by the sum of all of the credit limits on all those cards as well. So let's do an example here real quick. Let's pretend someone has two credit cards, one with $5,000 as the credit limit and one with $4,000 as the credit limit. So that means that their total credit limit for their two cards is $9,000. If they owe $3,000 across both of their cards, so it doesn't matter how much is on one versus the other, but let's say their total is $3,000, then what is their credit utilization ratio? Their credit utilization ratio is that $3,000 that's owed divided by the $9,000 that's their credit limit total. So 3,000 divided by 9,000, we can break that down and reduce that fraction to 3/9 or 1/3. So when we convert that to a percentage, that's 33.33%. So why do this calculation? Well, here's the rule. It becomes a red flag for credit card companies when someone goes above 30% in their credit utilization ratio. So that means that when someone's credit utilization ratio is greater than 30%, that hurts their credit score. When someone is able to keep their credit utilization ratio below 30%, and especially below 10%, it helps their credit score. Why is that? Remember that the credit limit is the amount that the credit card company feels you are capable of paying on time and feels comfortable with you being able to pay on time each month. So as someone spends more and more money on their credit card and their balance gets closer and closer to their credit limit, they unfortunately are more likely to not be able to pay all of that back on time. And so that's a red flag for the credit card company, and therefore this rule is in place. So let's think about the example from this particular example. Their credit utilization ratio, we calculated just now to be 33.33%. So are they helping their credit score or hurting their credit score? they're hurting it. It's above 30%. So how could they get that credit utilization ratio back below 20%? One strategy would be to pay back some of the $3,000 that's on those two credit cards. Let's say they were able to pay back half of it, and now their new credit utilization ratio would be calculated by doing $1,500 divided by 9,000, which is definitely less than 30%. Let's pretend that they couldn't afford to pay back any of the amount that's owed currently on those credit cards. How else could they reduce their credit utilization ratio back below 30%? One way is to increase their credit limit on the cards that they have already. So they could request a credit card limit increase from one or both of their credit cards. They could also apply for a third credit card. Let's pretend they apply for a third credit card, they're approved, and they receive a third credit card with a credit limit of $6,000. Now, when we calculate their entire credit utilization ratio, the sum of their credit limits is no longer $9,000. It's now $15,000. So even if they didn't pay any of the $3,000 back, their new credit utilization ratio calculation is $3,000 divided by $15,000. $3,000 divided by $15,000 we know is 1/5, and 1/5 as a percentage is 20%. Therefore, without even having to use that third credit card if they don't want to, they have still been able to reduce their credit utilization ratio back below 30%, and now they're helping their credit score. Now, it's also important to understand how to calculate the credit utilization ratio and why it's important to do so, because let's pretend the opposite of this situation was in place. Let's pretend this person had all 3 credit cards to begin with, but that third credit card with the $6,000 credit limit, they haven't used in more than a year. Let's pretend that they decide, you know what, I haven't used this in more than a year. I should just get rid of it and close the account. Now, it's not necessarily a bad thing to do that, but it's risky if they don't calculate or think of or even know to calculate their credit utilization ratio before closing that third account. As we remember, when they had the full $15,000 as their total credit limit, then their credit utilization ratio was 20%. Let's pretend they closed that third credit card with a $6,000 credit limit. Let's pretend they didn't know about the credit utilization ratio or what it even meant. So they closed that third credit card. Now their credit limit is at $9,000 because they closed that third credit card with $6,000 as the credit limit. Once they do that, then their credit utilization ratio increases up to that 33.33% that we calculated at the beginning. So that individual might start to see their credit score go down and not have any clue as to why, and not even think that it could be because they closed that third credit card. So before closing any credit cards, it's super important to calculate your credit utilization ratio on all of your credit cards together. Before doing so, to make sure that closing that third credit card won't increase your credit utilization ratio above 30%, which would start to hurt your credit score. Now, credit scores are important, and they're one piece of what we refer to as credit reports. Your credit report refers to you. It states all of your credit activity over the course of your life. It lays out your loan history and the status of your credit accounts, whether they're open or closed. And it's super important to check at least once per year. So where can you do this? Annualcreditreport.com is a website that is secure and free, and it allows you to pull your credit report free once per year from each of the 3 credit bureaus. The credit bureaus are TransUnion, Equifax, and Experian. And it's important to pull your credit report from each of them at least once per year, because not every bank, not every lending institution, not every car dealership reports to all 3 of the credit bureaus. So each credit bureau might have received different information for you, and it's important to be aware of what your credit report looks like at each of the 3 credit bureaus. So Therefore, annualcreditreport.com is super helpful because it provides you with a free credit report from each of those credit bureaus for free once per year. Why is this important? It's important to be aware of everything that's on your credit report. And it's also important to check your credit report for any mistakes. Sometimes mistakes are made when individuals have similar names. So someone might have a piece of information from a different individual on their own credit report because their names are similar. Other times people are malicious and they steal social security numbers. If that happens, someone might make a purchase, take out a loan under your social security number, and that's going to affect you and your credit score. And unfortunately, if you don't check your credit report, you might not actually be aware of that. So checking your credit report at least once per year from each of the 3 credit bureaus is super important, not only to have a comprehensive sense of where you are with your credit score, where you are with all of your credit accounts at any given time period, but also to verify and check that there aren't any mistakes and that identity fraud has not happened to you as well. Now, I encourage you to pause the video again right here and to utilize the practice credit report activity, which includes questions on each page. This is super helpful because it will give you some practice with how to read a credit report, and that will then serve and help you as you read your own. Now, overall, there are 3 rules to credit building. Have active accounts, make on-time payments, and keep your balances low. Having an active account means for a credit card that you might use it every month. You might only use it once per 6 months, but it's important to have it to be active, even if you don't use it very often. It's also super important to make on-time payments. As I mentioned, for credit cards or for other types of installment loans, you want to make sure that you're paying what is due prior to the due date. That will constitute and be reported as an on-time payment to the credit bureaus, and therefore will have a positive impact. In other words, increase your credit score. It's also important, as we mentioned with the credit utilization ratio on your credit cards, to keep your balances low. That means that when you have a credit card, look at its credit limit and calculate what 30% of that limit is, and try to make sure that you're spending less than 30% on that particular card at any given point in time. And what can you do now? You can work with a financial coach like myself in the Community College Credit Building Initiative. We can help you create your SMART goals. We can help you fine tune and create your spending plan as well. We can also help you build up your credit score and improve it. We can help you read your credit report. We can pull it for free for you as well. And we can help you work towards accomplishing the life goals that you have. So I encourage you to reach out to your professor or to your student club leader and to request from them our contact info and to schedule your one-on-one financial coaching appointment that can be done over the phone or virtually as well. Thank you.